All right, let's dive right in. Today, we're jumping into the high stakes world of corporate deal making. We're going to explore how and why some of the biggest companies you know decide it's just better to team up than to compete. So let's get to it. Okay, so here's a fun one for you. It sounds kind of like a riddle, doesn't it? But trust me, the answer here uncovers two really powerful strategies that are literally reshaping entire industries. Stick around and we'll connect all the dots. So first up, let's get the basics down. Whenever you hear about these gigantic corporate deals, we're talking about mergers and acquisitions, or just M&A for short. It's really the catch-all term for when one company's ownership and control gets passed over to another. The ultimate corporate team-up. Now, if you want to get technical about it, there is a difference. A merger is kind of like a marriage, right? Two companies join together to become one totally new thing. An acquisition is more like a straight-up takeover, where one company just buys the other one. But honestly, in the real world, you'll hear people use these terms pretty much interchangeably, because the end result is the same. One company is now running the show. Okay, so once two companies decide they're going to do a deal, they hit their first huge question. How are we going to pay for all this? And it really just boils down to two main options, and each one has its own set of risks and rewards. On the one hand, you've got your cash deal. It's clean, it's simple, and the value is totally locked in the second the papers are signed. On the other hand, you have a stock deal. So instead of cash, the seller gets shares in the company that's buying them. They become a part owner, and they're basically betting on the future success of this new, bigger company. And what's really interesting is how this choice creates totally different incentives for each side. For the acquirer, paying with cash means they keep full control, but it drains their bank account. If they pay with stock, they save their cash, but now their existing shareholders own a smaller piece of a bigger pie. And for the seller? Well, cash means total certainty, but stock? That gives them a ticket for the roller coaster ride, sharing in all the future wins and all the future losses. So it all comes down to this one fundamental tension. Do you take the guaranteed money and walk away, or do you roll the dice on a payoff that could be way, way bigger down the line? This single decision can really define the entire deal. Now to see how this all actually plays out, let's look at a real-world blockbuster deal. Walmart's absolutely massive acquisition of the Indian e-commerce giant, Flipkart. Just look at that number, $16 billion. This wasn't just some purchase. This was a colossal bet on the future of retail, and it sent shockwaves all through the industry. And this move is a perfect example of the risk involved. The second this deal was announced, Wall Street got, well, nervous. You can see Walmart's stock price just took an immediate nosedive. It wiped out billions in value. And investors were all asking the same simple question. And you know what? It's a fair question. Flipkart was definitely a rising star, but it wasn't profitable. It was burning through cash like crazy. So why would a company like Walmart, which is famous for being so careful with its money, pay top dollar for it? Well, to get it, you have to look past the bottom line. Just ignore those orange bars showing negative income for a minute. Look at the blue bars. That's revenue, and it was just skyrocketing. See, Walmart wasn't buying today's profits. It was buying tomorrow's explosive growth. And they didn't just dip a toe in the water. Before this deal, Flipkart's ownership was spread out across a whole bunch of different investors. Afterwards, boom, Walmart swooped in and grabbed a commanding 77% controlling stake. They weren't just investing, they were taking over. So at the end of the day, that $16 billion wasn't just for a website and some warehouses. It was a price of admission. It was a golden ticket to get into one of the world's fastest growing markets. Really, it was a strategic move to open up a new front in their global war with Amazon. So that brings us to a really fascinating twist in the M&A story. What happens when a company's most valuable asset isn't what it sells, but who it employs? This leads us to this really cool concept called the acquisition hire. It's just a mashup of the words acquisition and hiring. And believe me, it's a strategy that's become super popular, especially in the tech world. An acqui-hire is pretty much exactly what it sounds like. A bigger company buys a smaller one, usually a startup, not because they want its product, but because they are desperate to get its talented team. And in a lot of these cases, they just shut down the original product completely. So here's the key difference. A traditional M&A deal is all about buying things, assets, customers, market share. But an acqui-hire, it's all about buying people, a team that already knows how to work together, how to innovate, and how to build cool stuff. Now, while the steps here might look pretty similar to a normal acquisition, the focus is just completely different. The homework they do isn't just about profits and losses, it's about the team's chemistry and skills. The final price isn't based on market share. A lot of the time, it's just a simple calculation of a few $1,000,000 per talented engineer. So, after looking at these huge mega deals and these strategic talent grabs, what's the big picture here? Let's try and bring it all together. So, what are the big things you should remember from all this? First, M&A is a really powerful tool for growth. It's not just about getting bigger. Second, that simple choice between cash and stock completely changes the risk for everyone involved. Third, those giant price tags for unprofitable companies, they're not irrational. They're actually calculated bets on the future. And finally, the rise of the acquihire just proves that sometimes the most valuable asset you can possibly buy is a brilliant team. Which leaves us with one final, pretty powerful question. We've gone from valuing companies based on their factories to their products, and now to their people. So as innovation keeps driving our economy, is it possible the ultimate acquisition is no longer about buying things, but about buying the minds that create them? Thanks for joining us.